It started with leaked 2008 Fed transcripts. Trillions in emergency loans went to top banks, far more than public reports stated. Reporters cross-referenced central bank archives and found unpublicized preferential rates. Ordinary taxpayers footed the bill, while executives received bonuses. This wasn't a one-off error. It looked like a system tilted in favor of the powerful, sparking a global investigation into how the system really works behind closed doors. Early 20th century records reveal private banking alliances that shaped national currencies. Documents from the Bank of England archives show secret meetings where major lenders agreed to fix exchange rates and divide markets. Regulators at the time turned a blind eye as these institutions funded wars and infrastructure. Historians confirm these groups laid the foundation for modern central banking, blurring the line between public duty and private profit. In 1944, world leaders met to rebuild finance. Declassified cables show U.S. negotiators secretly struck deals to make the dollar the global reserve currency. This gave America unmatched power. It could print money to fund deficits while other nations hoarded dollars. Independent economists later proved this created an inherent imbalance, one that let wealthy nations dictate terms to developing economies from the very start of the modern system. By the 1970s, official records reveal a parallel system emerged. Shadow banks, regulated, unmonitored, and massive. Investigations by the Financial Stability Board found these entities handled trillions in assets, operating outside rules that protected savers. Leaked industry memos show banks deliberately moved risky activities here to avoid oversight. Regulators admitted they lacked authority to act, creating a two-tier system. Rules for some, freedom for others. In 2013, whistleblower emails rocked the Forex market. Investigations by global regulators proved top traders colluded daily to manipulate exchange rates, tricking trillions in daily trades. Banks paid billions in fines, yet no senior executive faced jail. Court documents revealed the practice dated back over a decade. Analysts noted small businesses and consumers lost billions, while the same banks kept profits, proving even the world's most liquid market wasn't fair. The London Interbank Offered Rate underpinned $350 trillion in contracts. 2012 investigations confirmed traders deliberately falsified rates to boost profits and hide weakness. Internal chats showed brazen coordination. If it ain't broke, don't fix it, but if it helps, fake it. Fines topped $9 billion, but the system itself wasn't overhauled. Experts argued this exposed a core flaw. Key benchmarks were controlled by those who benefited most from manipulating them. Central banks claim independence, but archived minutes tell a different story. Investigative reports show regular private meetings between bank chiefs and top financial executives. During crises, records prove central banks prioritized stabilizing big banks over protecting savers. Economists found their policies' low rates. Quantitative easing disproportionately benefited asset owners, while squeezing wage earners. The line between regulator and ally seemed dangerously blurred. Derivatives complex bets worth $600 trillion remain largely opaque. Investigations by the IMF found most trade over the counter, with no public pricing or oversight. Leaked bank risk reports reveal even insiders couldn't fully map exposure. Regulators admitted they couldn't track who owed what to whom. Critics argue this lets big players rig pricing, hide risks, and shift losses to the wider system, creating constant hidden instability. The Panama and Pandora Papers laid bare the scale. Over $32 trillion sits in offshore tax havens. Investigative journalists traced ownership to top banks, corporations, and billionaires. Records prove these jurisdictions are designed to shield wealth from tax, regulation, and accountability. While ordinary citizens pay full rates, the wealthiest legally avoid billions annually. Researchers found this distorts global capital flows, funneling wealth upward while starving public services. Investigations consistently point to regulatory capture. When watchdogs serve the industry they police. Official data shows over 60% of senior U.S. financial regulators later take high-paying jobs at the banks they oversaw. Emails reveal constant lobbying to weaken rules. Academic studies confirm captured regulators impose lighter penalties and delay reforms. The system, it seems, is policed by those with a stake in keeping it favorable to insiders. Declassified Treasury records from 2008 expose the bailouts' true scale: $29 trillion in support, not the advertised $700 billion. Investigations found big banks received funds at near zero interest, while struggling homeowners were denied relief. Internal memos show officials feared collapse of the system, but chose to rescue institutions, not people. Analysts concluded the crisis proved the rule: heads, banks win; tails, taxpayers lose. Credit rating agencies grade the very banks that pay them. Investigations after 2008 proved agencies knowingly gave top ratings to toxic mortgage-backed securities. Internal reports show they feared losing clients if they issued accurate grades. Court filings reveal executives prioritized revenue over truth. These ratings misled investors worldwide, yet the business model remains unchanged. A system where judges are paid by the accused can hardly be impartial. Investigations uncovered how high-frequency traders, HFTs, gain microsecond advantages. Data shows they pay exchanges for early access to market data, letting them trade ahead of ordinary investors. Regulators confirmed HFTs earn billions annually from this front-running. Independent tests proved this distorts prices and increases costs for retail traders. The playing field isn't level, it's tilted by technology only the wealthiest can afford. Developing nations borrow from global markets, but investigations reveal rigged terms. World Bank reports show they pay far higher interest than wealthy nations, even with similar creditworthiness. Secret loan contracts leaked to journalists include strict clauses that let lenders seize assets if payments slip. Economists prove this creates cycles of debt. Nations borrow to repay, never escaping. The system funnels wealth from poorer countries to rich creditors. For decades, gold prices were set via private meetings. Investigations in 2020 confirmed major banks colluded to fix daily benchmarks, affecting trillions in assets. Trading logs show coordinated buying and selling to move prices in their favor. Fines were issued, but the practice persisted in new forms. Gold, long seen as a safe haven, was just another market insiders could control to protect their own positions. Investigations into IMF policies reveal consistent patterns. When nations face crisis, loans come with strict conditions: cut welfare, privatize assets, open markets. Declassified documents show these policies often benefit Western corporations more than local populations. Independent studies prove they deepen inequality and slow growth. Critics argue these institutions act as gatekeepers, enforcing a system that serves wealthy nations rather than global equity. While retail traders face prison for insider dealing, investigations show corporate and financial insiders rarely do. SEC data reveals only 4% of insider trading cases. Target top executives. Despite evidence, they trade on non-public information far more often. Leaked reports show prosecutors avoid complex cases against powerful figures. The law, it appears, is applied selectively, punishing small players while shielding those who run the system. Cryptocurrencies promised freedom, but investigations found the same old rigging. Reports confirm wash trading, pump and dump schemes, and price manipulation are rampant. Large holders, known as whales, can move markets at will. Regulators admit oversight lags far behind innovation. Far from being a fair alternative, digital finance quickly mirrored the flaws of traditional markets: concentrated power, lack of transparency, and insider advantage. Central banks' money printing policies, quantitative easing were investigated extensively. Independent analysis found this drove up asset prices, stocks, bonds, property owned mostly by the wealthy. Meanwhile, inflation eroded the purchasing power of ordinary households. Official data confirms wealth inequality surged after each round of easing. Far from neutral, monetary policy acts as a wealth transfer mechanism from the many to the few. Investigative mapping projects revealed a tight network. Just 147 corporations control nearly 40% of global corporate wealth. Most are financial institutions. Board overlaps show they share directors, strategies, and influence. Researchers found this concentration lets them shape legislation, market rules, and economic policy. It's not a conspiracy, it's structural. A small group effectively governs the system that governs the world. Pension funds hold trillions in savings, but investigations show they're charged excessive fees by big banks. Internal fee schedules reveal hidden costs that eat up to 30% of lifetime savings. Reports prove banks steer funds toward higher-risk, high-commission products. Regulators found little transparency. Ordinary savers bear the risk, while financial firms pocket steady profits. It's another layer of the rigged system, working against ordinary people. Oil, food, metals, all subject to manipulation. Investigations by global watchdogs proved banks hoard physical commodities to drive up prices. Trading records show coordinated speculation that distorts supply and demand. The UN confirmed this raises food and energy costs for billions. Yet regulations remain weak. Essential goods vital to survival are treated as toys for financial players, with little regard for human impact. Case studies from Europe and the US illustrate the revolving door perfectly. A senior regulator drafts rules, then joins the bank he oversaw with a multi-million-pound salary. Leaked correspondence shows they use old contacts to weaken enforcement. Official inquiries confirm this practice undermines public trust. It's not corruption in the criminal sense, it's legalized influence, embedded deep within the system's structure. Declassified intelligence documents reveal nations use finance as a weapon. Investigations show sanctions, currency attacks, and asset freezes are regularly deployed. These actions destabilize economies, punish populations, and shift global power. Independent analysts confirm financial power is now as potent as military might. The system isn't just rigged for profit, it's an instrument of geopolitical control, wielded by the most powerful nations. Investigations repeatedly debunk the free market claim. Data shows governments and central banks intervene, constantly bailing out banks, propping up prices, guiding capital flows. Yet, when ordinary people ask for support, they're told markets must be free. Economists call this socialism for the rich, capitalism for the poor. The system is free only for those who can afford to bend its rules. Whistleblowers who exposed rigging Libor, Forex, tax evasion faced retaliation, firing, blacklisting, legal action. Investigations found few receive protection, while the institutions they expose rarely suffer severe consequences. Official reports note this culture of silence discourages others from speaking up. The system protects itself by punishing those who try to make it fair, ensuring secrets stay hidden. Decades of data confirm the system widens the wealth gap. Investigative reports show the top 1% holds 45% of global wealth. Economists prove financial policies, tax rules, and market rigging directly drive this. It's not accidental, it's baked in. The system rewards those who control it, while the rest bear its costs. Inequality isn't a side effect, it's how the rigging sustains itself. Investigations consistently find opacity enables rigging. Most financial transactions, ownership structures, and decision-making processes remain hidden. Even regulators struggle to access full data. Reports show transparency reforms are watered down by lobbying. Without sunlight, manipulation thrives. The system resists openness precisely because full disclosure would reveal how tilted it truly is. Research shows small firms pay higher borrowing costs, face stiffer regulations, and have less access to capital than large corporations. Investigations found banks prioritize big clients, offering them better rates and terms. This stifles competition, letting giants grow ever larger. The system claims to support enterprise, but in practice, it favors scale and power, crushing smaller players who might challenge the status quo. Further investigation shows even decentralized finance suffers the same flaws. Large investors control most tokens, manipulate liquidity pools, and dominate governance. Regulators found fraud and market abuse as common as in traditional finance. What began as a protest against rigged systems quickly replicated them. Technology alone can't fix structural inequality. If power concentrates, rigging follows. Investigations prove the system is designed to concentrate risk into big-to-fail institutions. Regulators admit these banks are so large, their collapse threatens the whole economy, guaranteeing future bailouts. This creates moral hazard. They take bigger risks, knowing taxpayers will cover losses. It's a permanent loop of profit and protection proof. The system is engineered to protect insiders from failure. No single body oversees the global financial system. Investigations show rules vary wildly, creating loopholes big enough for trillions to slip through. Nations compete to offer lighter regulation, a race to the bottom. Reports confirm this fragmentation makes global oversight impossible. The system is effectively ungoverned, free to be rigged wherever rules are weakest. Investigations also document growing pushback, activists, economists, and politicians demanding reform. Proposals include full transparency, breaking up big banks, ending the revolving door, and fairer taxation. Grassroots campaigns are gaining traction, and some nations have begun limited changes, yet powerful interests fiercely resist. The struggle to unrig the system is real, but the odds remain stacked against reformers. After analyzing thousands of documents, court records, and economic reports, one conclusion emerges: the system isn't naturally unfair, it's deliberately structured that way. Evidence of rigging in every major market, captured regulators, concentrated power, and preferential treatment isn't anecdotal, it's systematic. The data proves beyond doubt the global financial system is rigged to favor the few at the expense of the many. This investigation ends not with certainty, but a question. Will we accept a rigged system as inevitable or demand change? History shows reform is possible, but only when enough people understand how the levers work. The evidence is public, the patterns clear. The future of global finance depends on whether ordinary citizens demand transparency, accountability, and fairness, or let the hidden levers keep turning as they always have.